Journal Entries by Professor Carol Bruton, Fall 2014, Counting 201. Accounts are where we record transactions. There are 5 categories of accounts: assets, liabilities, stockholders' equity for corporation, owner's equity for proprietorship or partnership, revenues, and expenses. Note, within assets, there are current assets and property, plant, and equipment, and within liabilities, there are current liabilities and long-term liabilities. In a later chapter, we will have 6 categories of accounts: assets, liabilities, stockholders' equity, revenue, cost of goods sold, and expenses. Cost of goods sold will have accounts like purchases, purchase returns and allowances, purchase discounts, and transportation in. There are transactions. Examples of a transaction is buying your books, buying an iPod at Best Buy, paying your phone bill. And there's source documents. Transactions are recorded into accounts from source documents. Source documents examples are the receipt from buying your books, the receipt from buying your iPod, the phone bill, and the check that paid the phone bill. T accounts. The shape of a T stimulates the ledger account. Used a lot in teaching because a T account is faster to draw than a real ledger account. Note, I will use them lots this semester, so become comfortable with them. Debits and credits. All debit simply means is left, and credit simply means right. That's all. Just debit means left, credit means right. No more. The normal balance of an account. Assets are debit, and assets are on the left side of the balance sheet, so it makes sense. Left, debit. Liabilities are credit. Liabilities are on the right side of the balance sheet, so it makes sense. So right, it would be a credit. Stockholders' equity is a credit. Stockholders' equity is on the right side of the balance sheet, so right would be credit. Revenue is credit. A revenue increases owner equity, so it will be the same as owner's equity. An expense is a debit, and expenses decrease owner's equity, so it will be the opposite as owner's equity. The normal balance of an account. Increases are the same as a normal balance, so an asset, an increase would be a debit. Liabilities, an increase would be a credit. Owner's equity, an increase would be a credit. Revenue, an increase would be a credit. Expense, an increase would be a debit. Decreases are the opposite of a normal balance, so an asset, a decrease would be a credit. A liability would be a debit. Owner's equity would be a debit. Revenue would be a debit. And expenses would be a credit. The assets account are what you own. The current assets, a subcategory of assets, is expected to be used in the next year. That includes cash, marketable securities, accounts receivable, notes receivable due within 1 year, inventory, supplies, prepaid rent, and prepaid insurance. Notes receivable versus accounts receivable. Notes receivable is a formal written promise to pay or receive an amount plus interest, a formal borrowing or lending. Example, when you go to Bank of America and borrow $10,000, that is a note. Interest begins occurring the day of the note. Accounts receivable results from the sale of inventory and account. There is not a formal written note. There is no interest if paid on time. When you go to Nordstrom and charge a pair of $80 shoes, that is an accounts receivable from Nordstrom. Accounts receivable are always current assets. If a note receivable is due in less than 1 year, it's a current asset. If a note receivable is due in over 1 year, it's a long-term asset. There's property, plant, and equipment. You have equipment less its accumulated depreciation, giving you net equipment. Buildings less accumulated depreciation buildings, giving you a building. Land, which does not depreciate, and then providing you total property, plant, and equipment. There are contra asset accounts. The accumulated depreciation equipment and accumulated depreciation buildings are actually called contra asset accounts because the normal balance of an asset account is debit, and they always have a credit balance. There's 2 categories of accounts we won't go into of assets. Intangible assets, they're long-term assets. Copyrights, franchises, goodwill, patents, trademarks, leasehold improvements, and other long-term assets like notes receivable and long-term investments. There's liability accounts, which are what you owe. Current liabilities due within a year are accounts payable, dividends payable, interest payable, notes payable. They're due within a year. Salaries payable, which can be called wages payable, taxes payable, rent payable, and unearned revenues. And long-term liabilities, notes payable that are due over a year, bonds payable, and mortgage payable. Stockholders' equity and owner's equity accounts. If it's a corporation, stockholders' equity, common stock, retained earnings, and dividends declared. Dividends declared actually is a contra stockholders' equity account because it has the normal balance of a stockholders' equity account is a credit and it has a debit balance. Revenue accounts. Examples of revenue accounts are fees earned, sales, commission revenue, interest revenues, miscellaneous revenue, professional fees revenue, and rent revenue. Expense accounts. They will always end in the word expense. In advertising, depreciation, income tax, insurance, interest, miscellaneous, rent, salaries, supplies, and utilities are all examples. We have double entry accounting where it requires debits to equal credits in every journal entry. The general journal, is a record of transactions in chronological order before posting to the ledger. The journal is called the Book of Original Entry because the first place the transaction source section are listed is in the general journal. From the general journal, transactions are then recorded in the general ledger, frequently just called the ledger. In the general journal, transactions are listed in chronological order by date. So an entry on January 1st would be listed before an entry on January 2nd. An entry on January 3rd at 8 a.m. will be listed before an entry on January 3rd at 8:30 a.m. Journalizing is the act of recording journal entries. We call this the general journal because you will learn about special journals, which include the sales journal, purchase journal, cash payment, and cash receipts journal. Frequently, the general journal is just called the journal and the word general is left off. Transactions, journal entries. In a journal entry, the date is always first, the debits always listed first and to the left, and credits follow the debited accounts and are always indented. Tips for journal entries. Step 1. Read the facts and determine the 2 or more account titles involved. Step 2. For each account, determine the classification. That is it an asset, liability, stockholders' equity, revenue, or expense. For each account, determine if the account has increased or decreased. If it is an asset and is increased, assets are on the left side of the balance sheet, so lefts are increased debit. If it's an asset and is decreased, assets are on the left side of the balance sheet, so rights are decreased, so a credit. If it is a liability and it has increased, liabilities on the right side of the balance sheet, so rights are increased, a credit. If it's a liability and it's decreased, liabilities on the right side of the balance sheet, so lefts are decreased, debit. If it's a stockholders' equity and is increased, stockholders' equity are on the right side of the balance sheet, so rights are increased, a credit. If it's a stockholder equity and it has decreased, owner's equity are on the right side of the balance sheet, so lefts are decreased, a debit. This can be illustrated by the following balance sheet. See the assets on the left side, lefts are debit, liabilities on the right side, credit, stockholders' equity, credit. Revenues are good news to stockholders' equity, so it's a credit. If are an increase or regular balance, and expenses are bad news to stockholders' equity, so it's the opposite, it's a debit. Okay, let's do a couple example of journal entries. Please do your journal entries this way and not in T accounts. Thank you. Okay, on January 1st, the founders of the business sold $150,000 cash, common stock for cash. You would debit cash and credit common stock. On January 2nd, the business purchased an automobile. We put that in the equipment account for $5,000 cash. You would debit equipment, credit cash. On January 3rd, the business purchased an automobile, again the equipment account, for a note. Debit equipment, credit note payable. On January 4th, the business purchased a building for cash. Debit building and credit cash. On January 5th, the business purchased a building for a mortgage. Debit building, credit, mortgage payable. On January 6th, the business purchased land for cash. Debit land and credit cash. On January 7th, the business purchased land for note. Debit land and credit note payable.